Supermicro maintains deep operating partnerships with major semiconductor providers, most notably Nvidia, enabling the company to deliver GPU-accelerated systems optimized for AI training and inference workloads. Its product portfolio spans both air-cooled and liquid-cooled architectures and designed specifically to support higher power densities while improving overall energy efficiency. These systems are engineered to meet the performance demands of modern AI infrastructure, while simultaneously addressing constraints around power usage, thermal management, and deployment reliability. A central element of Supermicro's operating model is vertical integration. By keeping design, manufacturing, and global supply chain operations in-house, the company is able to offer customers configurable infrastructure that can scale quickly while maintaining control over cost structures, power consumption, and deployment risk. This integrated approach allows Supermicro to respond rapidly to shifting customer requirements, shorten delivery timelines, and customize platforms across a wide range of performance tiers. As a result, the company serves a diverse customer base that includes enterprise clients, hyperscalers, and AI-focused organizations that require both flexibility and speed in infrastructure deployment. These are the core requirements shaping infrastructure purchasing decisions in the current market environment. With this operating foundation established, recent strategic developments offer additional insight into how the company is positioning itself for the next phase of growth. Supermicro recently outlined a broad expansion across both hyperscale and enterprise AI markets. As part of this initiative, the company has increased manufacturing capacity and advanced its liquid cooling capabilities in preparation for upcoming Nvidia Vera Rubin platforms, which are expected to become commercially relevant in 2026. These investments reflect management's focus on supporting higher-density compute architectures while maintaining thermal efficiency and reliability at scale. The strategic objective behind these investments is to shorten deployment timelines by integrating several internal capabilities into a unified delivery model. This includes combining in-house system design, rack-scale manufacturing, and the company's modular data center building block solutions. By controlling each layer of the infrastructure stack, from component integration to rack deployment and data center modularization, Supermicro aims to reduce complexity for customers while improving speed to market. This approach is particularly relevant as hyperscale and enterprise customers increasingly seek turnkey solutions that can be deployed rapidly and scaled predictably across multiple sites. At the same time, Supermicro has expanded beyond traditional large-scale data center deployments. The company introduced new AI workstations, AI PCs, and edge systems built on Nvidia, Intel, and AMD platforms. These products are designed to bring server-grade AI performance into desk-side, on-premises, and edge environments. This expansion targets developers, startups, research teams, and enterprise users who require high-performance AI compute outside centralized data center environments. By extending its infrastructure footprint closer to end users, Supermicro is positioning itself across a broader range of AI use cases, including development workflows, applied research, real-time inference, and localized data processing. Collectively, these initiatives demonstrate that Supermicro is scaling in two directions simultaneously. On one side, the company is deepening its role in next-generation AI factories by building out rack-scale and cluster-level solutions for hyperscale deployments. On the other side, it is pushing enterprise-class AI compute closer to the edge by offering desk-side and localized systems that deliver server-grade performance in distributed environments. This dual-track strategy reinforces Supermicro's broader operating model of applying the same modular design principles, cooling technologies, and integration expertise across the full spectrum of AI deployments, from centralized data centers to edge environments and desk-side workstations. With the strategic backdrop established, the next step is to examine how these developments are translating into financial performance. In the first quarter of fiscal 2026, Supermicro reported revenue of $5 billion. This represented a decline of approximately 15% from $5.9 billion in the same period last year, reflecting softer demand and changes in customer ordering behavior. These shifts suggest that while underlying AI infrastructure demand remains structurally strong, near-term purchasing patterns have become more cautious, particularly among large customers adjusting deployment schedules and inventory strategies. Net income for the quarter declined to approximately $168 million, down from $424 million in the prior year period. This represents a decrease of about 60%, driven primarily by lower gross profit and higher operating costs. Gross margins declined to roughly 9% for the quarter, compared with approximately 13% in the same period last year. This margin compression reflects a combination of higher input costs, competitive pricing pressure, and changes in product mix toward lower margin configurations, even as shipment volumes remained relatively strong. Despite the decline in profitability, liquidity remains a significant strength for the company. Supermicro reported approximately $12.7 billion in current assets, compared with $2.35 billion in current liabilities, resulting in a current ratio of 5.39. This indicates that the company holds more than $5 in short-term assets for every $1 of short-term obligations. Such a liquidity position provides substantial financial flexibility, enabling Supermicro to support working capital needs, fund ongoing capital investments, and absorb short-term fluctuations in demand or margin without compromising operational stability. In addition to strong current assets, Supermicro ended the quarter with approximately $4 billion in cash and cash equivalents. This cash balance represents a sizable buffer that supports day-to-day operations, supplier commitments, inventory management, and ongoing investments in manufacturing capacity and product development. It also provides management with optionality to respond to market shifts, customer demand changes, or competitive pressures without requiring near-term external financing. Looking ahead, management guided second quarter fiscal 2026 revenue to between $10 billion and $11 billion. For the full fiscal year, the company expects at least $36 billion in revenue. These forward projections indicate management's expectation for a meaningful acceleration in revenue compared with the first quarter, reflecting anticipated normalization in customer ordering behavior and continued deployment of AI infrastructure across hyperscale and enterprise markets. With the financial profile established, the key analytical question becomes what factors could drive renewed growth from this point forward, and what risks could potentially constrain performance. This topic has surfaced repeatedly in investor discussions, including within Discord communities, highlighting growing interest in the company's medium and long-term trajectory. One of the most significant growth catalysts for Supermicro remains its deepening partnership with Nvidia. This partnership directly links Supermicro's product roadmap to the rollout of next-generation AI infrastructure platforms. A clear example of this integration is Supermicro's delivery of turnkey AI factory clusters, based on Nvidia enterprise reference architectures and Blackwell GPUs. These systems are designed to provide end-to-end, ready-to-run AI infrastructure, encompassing compute, networking, power, and cooling in tightly integrated platforms optimized for large-scale AI workloads. In parallel, Supermicro is expanding manufacturing capacity and liquid cooling support for the upcoming Nvidia Vera Rubin and HGX platforms. These platforms are expected to demand higher power densities and more advanced thermal management solutions, reinforcing the strategic importance of Supermicro's investments in liquid cooling architectures. By aligning its manufacturing and cooling infrastructure with Nvidia's next-generation compute platforms, Supermicro positions itself as a preferred infrastructure partner across multiple generations of AI hardware cycles. This alignment matters because it transitions Supermicro from being perceived primarily as a server manufacturer to being positioned as a full-stack AI infrastructure provider. Turnkey AI factory solutions, complete, ready-to-run systems rather than component-level offerings, tend to increase average deal sizes, deepen customer lock-in, and improve competitive positioning across both enterprise and hyperscale deployments. These solutions also simplify procurement and deployment processes for customers, reducing integration risk and accelerating time to production. As a result, Supermicro gains leverage not only in system-level sales, but also in broader infrastructure partnerships and long-term platform relationships. Beyond commercial enterprise and hyperscale markets, Supermicro has also formed a dedicated federal entity to deliver U.S.-manufactured data center systems for government customers. This strategic move opens the door to larger contract opportunities, deeper agency relationships, and more durable revenue streams tied to long-term federal AI, infrastructure modernization, and national computing initiatives. Government procurement cycles often favor domestic manufacturing, long-term supplier relationships, and integrated delivery models, areas where Supermicro's vertically integrated operations and modular infrastructure platforms may offer structural advantages. Over time, this federal channel could diversify revenue streams while reducing cyclicality tied to commercial enterprise spending patterns. However, no investment thesis is complete without a rigorous assessment of risk factors. At present, the most pressing operational risk facing Supermicro is margin pressure. Gross margin declined to approximately 9% from roughly 13% in the prior year. This deterioration reflects higher component costs, pricing pressure in competitive markets, and shifts in customer purchasing behavior toward configurations with lower contribution margins. Even with strong shipment volumes, each dollar of revenue now generates less gross profit than it did previously. If margins remain at these levels, sustaining earnings growth becomes increasingly difficult. Lower margins constrain operating leverage, limit reinvestment capacity, and reduce financial flexibility over time. This also increases exposure to adverse demand shocks or further cost inflation, as the buffer between revenue and operating expenses narrows. In an environment where customers remain cost-sensitive and infrastructure pricing competition intensifies, restoring margin stability will be critical to translating revenue growth into sustainable earnings expansion. With both growth catalysts and risk factors in view, attention naturally turns to the stock's current valuation and market positioning. Supermicro currently trades around $32 per share, giving it a market capitalization of approximately $17.5 billion. Over the past 52 weeks, the stock is up about 5%. However, when viewed over a longer horizon, performance has been materially stronger. Over the past 3 years, the stock has risen approximately 3 out of 8%, reflecting the company's exposure to the accelerating build-out of AI infrastructure and data center modernization. From a sell-side perspective, consensus sentiment remains constructive. Among 19 analysts, the stock carries a moderate buy rating, representing an upgrade from a hold rating over the past 3 months. The average analyst score stands at 3.47 out of 5. The highest published price target is $64 per share, implying the stock could nearly double over the next year if those expectations are realized. These ratings reflect optimism around Supermicro's positioning within the AI infrastructure ecosystem, balanced against near-term concerns related to margin compression and execution risk. The larger strategic question, however, centers on whether Supermicro can realistically deliver five-fold upside by 2030. At approximately $32 per share and a market capitalization of $17.5 billion, a five-bagger outcome would imply a valuation of roughly $90 billion by the end of the decade. Achieving that level of appreciation would require more than multiple expansion alone. It would necessitate a substantial increase in underlying earnings power, supported by sustained revenue growth and margin recovery. In practical terms, this scenario would likely require net income to reach approximately $2 to $2.5 billion by 2030. That earnings profile would assume revenue in the range of $55 to $65 billion, gross margins recovering to approximately 12% to 15%, and operating margins expanding into the 5% to 7% range. At those earnings levels, a $90 billion valuation would imply a price-to-earnings multiple of around 40. While elevated, such a multiple is not unprecedented for companies positioned as critical enablers of structural technology shifts, particularly within AI infrastructure markets. Historically, revenue growth tends to lead during infrastructure expansion cycles, while margins often compress during periods of heavy capacity investment and competitive pricing pressure before recovering later as scale efficiencies improve and product mix stabilizes. Whether Supermicro follows this pattern will depend on execution across manufacturing scale-up, cooling innovation, platform integration, and customer retention. It will also depend on the sustainability of hyperscale AI investment cycles and enterprise adoption of AI infrastructure across both centralized and edge environments. Ultimately, Supermicro's trajectory will be shaped by its ability to translate infrastructure leadership into durable financial performance, sustaining revenue growth while restoring margin discipline and maintaining balance sheet strength. The company's vertically integrated model, deep partnerships with Nvidia, and